Hi, I'd like to take a few moments today to talk to you about the concept of Nexus as it relates to state and local taxation. I remember not long ago talking to one of my clients, and he was telling me about how he was going down to the US to do business. He was visiting his customers in the States, he was making sales in the States, demonstrating and installing product, offering training, doing all kinds of things to help his customers. When I told him that he quite likely had sufficient contact to create Nexus in all of those states, he stopped and asked me, what exactly is Nexus? Is it a good thing or a bad thing? And if it's a bad thing, what do we do about it? Now, Nexus is not well defined. As a matter of fact, there's a lot of things in tax regulation that aren't not well defined. One of the worst is income. It's simply defined as income from whatever source, which doesn't really help. Nexus isn't even defined that well. Its definition is predominantly based on a series of cases put out by the Supreme Court. Now, Nexus is restricted, and states are restricted from imposing tax by two key principles of the U.S. Constitution, the Due Process Clause and the Commerce Clause. The Due Process Clause says that there has to be some minimal connection between the jurisdiction and the person they're trying to tax. That's not really helpful because what exactly is a minimal connection? The courts have gone further under the Commerce Clause and said that you have to have substantial nexus in order to be taxable. Again, that's really not that helpful, although the courts did go to say that substantial nexus, for sales tax at least, requires some physical presence within the state. Be that employees physically present in the state or property physically present in the state, there has to be some physical presence. Now, my client said, Ed, as a Canadian, I'm covered by the treaty, aren't I? And I had to inform him that, well, the states don't sign the treaty, so they're not bound by it. Most of us in Canada are comfortable with the fact that provinces are all bound by federal law. And so when the federal government negotiates a treaty, the provinces all step into line. That's not so in the United States. As a business person, you'll find that each of the states has its own regulations, has its own laws, has its own taxes. And so you may not have federal tax under the treaty, but you still have tax exposure for the states. And that comes down to whether or not you have nexus. So back to my client's question about whether having nexus is a good thing or a bad thing. There is no one set answer for everybody. Your particular circumstances and your tax position is going to determine whether or not it's advantageous for you to have nexus in certain states or to avoid it. There are ways to set up your business so that you don't have nexus or so that you can avoid tripping nexus in certain states. We recommend that you sit down with your tax advisor or someone who's competent to give you advice in this area to determine how best to arrange your affairs. If you have questions about nexus, or if you'd like to talk to us further about your doing business in the United States, please feel free to contact one of our cross-border specialists at Ailett Grant Tax. We're here to help. Thank you.